Let me ask you something. Right now, a lot of people are worried about banks. They're watching the Federal Reserve, watching interest rates, watching for the next Lehman Brothers moment. And look, that's fair. Banks have crashed the economy before. But here's what most people are not talking about. What if the next economic shock doesn't come from a bank at all? What if it comes from something sitting in the ground, from oil? Because here's the thing. Oil isn't just fuel for your car, it's fuel for the entire global economy. And when it moves, when supply suddenly tightens, when prices spike, when the market panics, everything moves with it. Your groceries, your gas bill, your job, your 401k, all of it. So today, we're going to talk about the threat hiding in plain sight. And by the end of this video, you're going to understand exactly how an oil shock works, why it's more dangerous than most people realize, and what you can actually do about it. Let's get into it. First, let's define our terms. What exactly is an oil price shock? An oil price shock happens when the price of crude oil rises or falls dramatically and fast. Not a gradual 10% shift over a year. We're talking 30, 50, sometimes 100% in a matter of weeks or months. And this can happen for a number of reasons. Supply disruptions, like a war in a major oil-producing region, or OPEC deciding to slash production overnight. Demand crashes, like what happened in 2020 when COVID shut down the global economy and oil prices actually went negative. Yes, negative. Producers were paying people to take oil off their hands. Or geopolitical decisions, sanctions, trade embargoes, political instability in places like the Middle East, Russia, or Venezuela. The point is, the trigger can be almost anything, but the result is almost always economic chaos. And here's why. Oil has brought the US economy to its knees before, multiple times. The most famous example? 1973. OPEC, the Organization of Arab Petroleum Exporting Countries, declared an oil embargo against the United States. Why? Because the US supported Israel in the Yom Kippur War. The result was devastating. Oil prices quadrupled almost overnight. Gas lines stretched for miles across America. Inflation surged. The economy went into recession. The stock market tanked. Then it happened again in 1979 during the Iranian Revolution. More supply disruption, more price spikes, another recession. Fast forward to 2008, oil hits an all-time high of $148 a barrel in July, and then crashes to $30 just 6 months later. That volatility helped push an already fragile economy right into the Great Recession. And in 2022, Russia's invasion of Ukraine sent energy prices skyrocketing across the globe. The US saw gas prices hit record highs. The Fed had to scramble to fight inflation. We're still feeling the effects of that today. The pattern is crystal clear. Oil shocks don't just hurt at the pump, they ripple through every layer of the economy. And the warning signs are starting to flash again. So what's going on right now in today's market? A few things are converging that have serious economists paying close attention. First, OPEC Plus production cuts. Saudi Arabia, Russia, and their partners have been deliberately cutting oil output to keep prices elevated. That means supply is tighter than it looks. Second, Middle East instability. Ongoing conflict in the region keeps the threat of supply disruption very real. One major escalation, and global oil supply could tighten fast. Third, the green energy transition. This one's ironic. As the world moves towards renewables, investment in new oil production has dropped significantly. That means in the short to medium term, we could actually face a supply crunch even as demand stays strong. Fourth, the US dollar. Oil is priced in dollars globally. If the dollar weakens, which it has at various points recently, oil becomes more expensive for everyone. That can accelerate a price spike. Now, I'm not here to tell you a crash is guaranteed, but I am here to tell you these are real risks that deserve more attention than they're getting. So let's talk about what actually happens to your life if oil prices spike. Before we go further, if you're finding this valuable, hit that like button right now. It genuinely helps this channel reach more people. And if you haven't subscribed yet, now is a great time. We drop new finance explainers every week.
Okay, let's make this real, because when most people hear oil prices, they think gas at the pump. And yes, that's definitely part of it, but it goes so much deeper than that. Think about everything you buy: groceries, clothes, electronics, furniture. Almost everything you purchase was transported to a store or your front door using oil. When oil prices go up, shipping costs go up, and those costs get passed directly to you. Your grocery bill goes up, your Amazon order gets more expensive, even your online subscription services are affected because the companies behind them have operational costs tied to energy. Then there's heating. Millions of American homes are heated with natural gas or heating oil. A severe energy price spike in winter isn't just inconvenient, it's a financial crisis for working families. And here's the sneaky one most people miss: airfare. Airlines run on jet fuel, which is basically refined oil. When oil spikes, airlines raise ticket prices. Your vacation just got more expensive. Small businesses get hit hard too. Restaurants, contractors, delivery services, they all have energy costs baked into their operations. Higher energy equals higher prices, equals you paying more for everything. The bottom line, an oil shock is essentially an invisible tax on your entire lifestyle, and the people who feel it the most are lower and middle-income Americans who are already stretched thin. Now let's zoom out to the macro level. What does an oil shock do to the broader financial system? First, inflation. Higher oil prices push up the cost of nearly everything, as we just covered. That means inflation goes up, and when inflation goes up, the Federal Reserve has a problem. Because the Fed's job is to keep inflation in check, and the main tool they use? Interest rates. They raise rates to slow down the economy and cool inflation. But here's the trap. Higher interest rates make borrowing more expensive. Mortgages go up, car loans go up, business loans go up, consumer spending slows down, and when that happens, the economy can tip into recession. That's called stagflation, high inflation and a slowing economy at the same time. It's one of the hardest scenarios for policymakers to deal with, and oil shocks are one of the few things that can reliably create it. As for the stock market, energy stocks tend to do well initially when oil prices spike, but the broader market, it gets nervous. Uncertainty about inflation, interest rates, and economic growth tends to drag down valuations. Your 401k, your index funds, they can take a hit. So, what can you actually do? Here's the good news: you're not powerless. Number one, build a cash cushion. In times of economic uncertainty, having 3 to 6 months of expenses in a high-yield savings account gives you breathing room. You won't need to panic sell investments or go into debt when prices spike. Number two, consider energy sector exposure in your portfolio. ETFs that track oil and gas companies or commodities broadly can act as a hedge when energy prices spike. I'm not saying go all in, but a small allocation can help balance your portfolio during oil shocks. Number three, reduce variable energy exposure where you can. Is your home energy efficient? Could you refinance a variable rate loan before rates climb higher? Small moves now can reduce your vulnerability later. Number four, stay informed. This is exactly why channels like this one exist. The more you understand how these systems work, the better decisions you can make before the headlines start screaming. Quick pause. If this video is helping you think differently about the economy, subscribe to the channel right now. We break down complex financial topics every week so you can stay ahead, not behind. Hit subscribe and turn on notifications so you never miss one. Here's the big picture takeaway today. The next economic shock might not announce itself with a banking scandal or a Wall Street collapse. It might start quietly, in a pipeline, in a political decision, in a barrel of crude oil sitting in the Middle East. The people who get hurt the most in economic shocks are the ones who weren't paying attention. So the fact that you're here, watching this video, doing this research, that already puts you ahead of most people. Now, I want to hear from you. Do you think an oil shock is a bigger threat to the US economy right now than a banking crisis? Drop your answer in the comments below and tell me why. I read every single comment. If this video opened your eyes to something you hadn't considered before, smash that like button. It genuinely helps more people find this content. Subscribe if you haven't already, and I'll see you in the next one.